Have you ever looked at your savings account and just felt stuck, like your money isn't really doing anything? Well, if that sounds familiar, you are in exactly the right place. Today, we're going to demystify two really powerful tools that are designed to help pretty much anyone build wealth, starting with whatever you have right now. Okay, so let's dive right in with a problem that honestly affects all of us, whether we realize it or not. There's this silent force that's chipping away at your hard-earned cash as we speak. So is it just a feeling, or is your money really losing value? Well, the answer, unfortunately, is a big yes, and it's all because of a little thing called inflation. It's simple, really. Every year, the price of everything, from food to fuel, it just goes up. Think about it like this. That 100,000 naira you tucked away last year, it buys you less stuff this year. And look at this. Over just 5 years, the actual buying power of your cash can drop, like a lot. It's like your savings account has this slow, invisible leak, and it's silently draining away your wealth. So, how in the world do you fight back against this silent threat? Well, the solution is actually pretty cool, and it's rooted in an idea that's been around forever: the power of community. You see, the real secret to growing your money, for most of us anyway, isn't about trying to be some lone wolf genius investor. No, it's about harnessing the incredible strength that comes from pooling our resources together for one common goal. And this idea is probably super familiar to you. If you're from West Africa, you know it as Aho or Esesu. In East and Southern Africa, you call it a chama or a stockville, right? These are those traditional savings groups where everyone pitches into a common pot. We're talking about that exact same powerful idea just applied to the modern world of finance. So the official kind of fancy name for this is a collective investment scheme. But don't let the name scare you. Just think of it as a huge regulated pot where thousands of people can pool their money. This lets regular people like you and me own a tiny piece of a massive portfolio. I'm talking stocks in huge companies, government bonds, stuff that would be pretty much impossible to buy on your own. Now, this whole concept really comes in two main flavors that you're going to hear about all the time: mutual funds and exchange-traded funds, or as everyone calls them, ETFs. You know, probably the easiest way to think about the difference is right here. Mutual funds are kind of like the invest and relax option. You hand your money over to a pro and they handle the rest. ETFs, on the other hand, are more of an invest and trade kind of deal. They're like these pre-made baskets of investments that you can buy and sell all day long, just like a single stock. All right, let's break this down a bit more. With a mutual fund, you can only buy or sell it once a day at whatever price it closes at. But with an ETF, you can trade it constantly whenever the market's open. Now, here's the big one: management. Most mutual funds are actively managed, meaning some manager is trying to pick winners and beat the market. That's why their fees are usually higher. ETFs, they're typically passive. They just follow a market index like the S&P 500, which is why their fees are way, way lower. And finally, getting access. You can often buy mutual funds right from an app, but for ETFs, you'll usually need a brokerage account. Okay, so before you get all excited and jump in, we gotta have a little reality check. Let's get real about the potential rewards, and more importantly, let's bust some of the big myths that stop people from even getting started. This one. This is probably the number one myth we all hear, right? The idea that investing is some exclusive club and you need a ton of money just to get in the door. But is that really true? No way. That's just flat out not true. I mean, the whole point of these funds was to open up investing for everybody. In Nigeria, for example, you can get started in a lot of mutual funds with just 5,000 naira. You can absolutely start building a real portfolio with small, consistent contributions. And here's the other big fear, right? That putting your money into the market is just a roll of the dice. That is basically a trip to the casino where the odds are you're going to lose everything. This is just a huge misunderstanding of how this works. In fact, the main idea here, diversification, is the exact opposite of gambling. See, instead of putting all your money on one company, one bet, your money is spread out across dozens or even hundreds of them. For you to lose everything, all of those companies would have to go bankrupt at the exact same time. It's just incredibly unlikely. So what can you realistically expect? Well, historically, a big market index like the US S&P 500 has averaged around 10% a year. And in Nigeria, even safer money market funds have often paid out 10 to 15%. But here's the key thing to remember, and it's super important. Investing is a marathon, not a sprint. The value of your investments will go up and they will go down. Patience is truly your best friend. All right, so with all of that in mind, how do you figure out what your next move should be? Let's walk through a really simple framework to help you decide. First things first, and I cannot stress this enough, ask yourself this: do you have a safety net, an emergency fund? Before you even think about investing for growth, you absolutely must have 3 to 6 months of your living expenses saved up somewhere safe and easy to get to. This is what protects you from having to sell your investments at a terrible time if life throws you a curveball. Okay, next up, what's your time horizon? Basically, when are you going to need this money? Money you need for short-term goals like, say, paying your rent next year, that needs to be kept safe, not invested. But for your long-term goals like retirement way down the road, well, then you have time to ride out the market's bumps, which makes growth investing a much better fit. So there you have it. The framework is simple as 1, 2, 3. Step 1, build that safety net. Step 2, figure out your goal and your timeline. And only then in step 3, do you choose your tool, whether it's the Invest and Relax mutual fund or a super low-cost ETF. You know, this whole thing isn't about getting rich overnight. It's about taking one deliberate, consistent step towards building a more secure financial future. It's about planting a tree today so you can enjoy the shade for years and years to come. So I guess the only real question left is, what's your first move going to be?